Hello, everyone, and welcome to the June session of our ongoing webinar series. This one is Putting Your Cash to Work, 4 Strategies for Excess Cash in Volatile Markets. My name is Tom Bittinger, and I'm with the marketing team here at Wealth Enhancement. And before we get going, just want to go over a few quick housekeeping items. There will be a Q&A session at the end of this presentation, so please feel free to use the questions pane on your webinar window. We'll get to as many as we can, but anything we don't get to during the session, we'll forward on to your advisor, and they should be able to answer those questions for you. And then again, there will be a recording of today's session, so if you have to step out for a second, or if maybe you missed anything and need to revisit, no worries. We will send the recording to your inbox, or check it out on our YouTube channel as well. We've got a lot of great content there, so be sure to also look out for this there, likely on Friday, but if not Friday, then early next week. So jumping into it, it's my honor to introduce today's presenter. Daniel Goodman is a senior financial planner here at Wealth Enhancement. He is a chartered life underwriter with a BA in economics from San Jose State University and an MBA in investment management quantitative decision method from Santa Clara University. So he's a very smart guy, very knowledgeable about all this stuff. And I think we are in for a great session today. So Daniel, take it away.
Well, thank you very much, Tom. I appreciate the introduction. Good afternoon, everybody. So today we're talking about cash management strategies and how to make your excess cash do more. Now, there's a couple of reasons why people might have excess cash. And when we say excess here, please note that it's a subjective term and everyone's definition will be different. But there are a number of scenarios where you might find yourself with what could be labeled as excess cash. Maybe you just received a large inheritance. Perhaps you just had a bunch of stock options vest, or you got a sizable bonus at work. And if you did, good for you. Maybe it's as simple as you're no longer paying for something you used to, like your mortgage. And now that money is starting to pile up when you're not making those payments. Well, whatever the case may be, for the purposes of today's discussion, there are a couple of reasons why you might be hanging on to excess cash. And the first one is simply to reduce portfolio risk in uncertain times, kind of like what we've been going through for the last couple of months. And when there's uncertainty or volatility in the markets, people tend to want to avoid that. And that is only natural. It's natural to feel uneasy when you see markets going up and down. And so you might feel like you just want to stay out of the market altogether, hang on to that cash, and just reinvest it back after things have settled down a bit. This is actually a psychological phenomenon, and it's called loss aversion. And it's something you hear a lot about in sports, as a matter of fact. It's when the pain of a loss feels more significant than the joy of a win. So when equity markets start to go haywire, like they did back in March and April, that uncertainty and those losses might have hurt a lot more than the joy you felt when they bounced back up in late April and then surged again in May. Now, while loss aversion is a natural feeling, that doesn't mean market timing or pulling your money out of the market before a downturn and then buying back in before an upturn, that's a solid strategy. Because market timing does not amount to avoiding risk, but rather it introduces an entirely different type of risk. The risk that you fail to predict the right point to sell and reinvest those proceeds. Even if you're fortunate to get the timing right once, that isn't good enough, unfortunately, because you're going to need to make that same decision correctly time and time again because the market is cyclical. And guessing wrong with your market timing can have a significant impact on your portfolio. Let's just take a quick look at that. So this chart shows the growth of just $10,000 invested in the S&P 500 from the end of 1979 through March of this year. So as you can see on the bar on the left, remaining invested over the course of that entire period would have yielded over $1.6 million. But as you start to miss out on those best days in the market, you start to see that number come down quite a bit. As a matter of fact, missing just the 5 best days in the market brings the total yield down a whopping $600,000. And missing the best 10 days cuts the total yield in half. But you might be saying to yourself, Daniel, that's all fine and dandy if you have a few decades to let your investments grow. But what if I don't feel like I have the luxury of time on my side to weather these bouts of volatility? Well, if that's the case, instead of avoiding the markets altogether and holding on to cash, consider looking for ways to reduce your portfolio risk by looking for other investment strategies. Because as we saw, based on historical data, it's better to stay invested through the periods of volatility so that you can take advantage of those gains when the market recovers. And history clearly shows us that the market will eventually recover. As you can see on this chart, while there are brief periods of decline, we can see that over the last 40 years, the S&P 500 has generally been on an upward trajectory. So again, while those periods of decline might sting and hurt, staying invested through that volatility can help you ensure you take full advantage of those periods of growth. Now, moving on to other reasons why you might want to hold on to excess cash. You want to stay nimble and prepare for the unexpected. An example of this might be an emergency fund you keep on hand in case of something like a hot water heater needs to be replaced, or you have some other costly home repair. Without a liquid supply of cash available, you might need to draw from your taxable investments to pay for something like that. And that could very well create a tax bill for you. Another example might be to fund some short-term goals you might have. Maybe you want to renovate your kitchen. Maybe you want to take the family on a vacation. Whatever it is, maybe you've even been saving up for something big but can't afford to deal with the ups and downs of the volatile market should a sudden downturn wipe away all those savings. And finally, maybe you just want some fun money. Maybe you want to be able to splurge on a shopping trip or a spontaneous vacation without the need to reduce spending in some other category, or dip into that savings that you built to fund that longer-term goal. Your life stage can also give you some general guidance around how much cash to have on hand. For example, those folks that are in retirement, they might keep up to 12 months of living expenses in case of unexpected expense or market volatility. While those who are still working and receiving a regular paycheck may wish to keep up about 6 months of living expenses in case of unexpected loss of income or, again, unexpected expenses. But no matter your life stage, working with a financial advisor can help determine the level of cash holding that is appropriate for a particular person. And with the help from your advisor, you can create a personalized strategy for your cash that can meet your goals and prepare for the unexpected. And speaking of, let's go ahead and dive into the meat of today's discussion. We're going to cover 4 different cash management strategies for excess cash. And like we said earlier, if you have excess cash, there are strategies you can employ that can help make your cash work harder for you than just sitting around in a bank account. Yeah, if that money is in a checking or a savings account, it might be earning an annual percent yield, some kind of interest. But is that small amount really moving the needle? Most likely it's not. But however, one or more of these strategies can be deployed to help you check those 2 boxes we just talked about: reduce portfolio risk and being nimble, having liquid funds to help you plan for the unexpected, while still helping you work toward your overall financial goal. And the great thing about your financial advisor here at Wealth Enhancement is that they can help you deploy any of these clever liquidity strategies. So let's take a closer look. And we're going to start with collateralized loans. A collateralized loan is also known as a securities-based line of credit, or an S block, is a loan secured by the value of your taxable investment portfolio, usually at some variable interest rate. Collateralized loans can help you finance short-term or unexpected expenses without requiring you to liquidate your investment holdings. An S block lets you fund unexpected expenses or opportunities, so you can avoid selling stock when it is at a low or triggering a capital gain on the sale of highly appreciated stock. Now, while retirement accounts aren't eligible collateral for these types of loans, you may be able to use this strategy with a taxable brokerage account. And the amount you borrow could be as high as 70% of the value of the portfolio you were pledging. For example, if you have $1 million in your taxable brokerage account, you may be able to borrow up to $700,000. Beyond helping you cover costs, such as an unexpected tax bill, a securities-based line of credit can help you bridge a funding gap. For example, the time between selling one home and purchasing a new one. An S-block can also enable you to finance new investment opportunities, such as a new business warehouse or the purchase of a multifamily building. It might also allow you to cover a cash crunch without dipping into your emergency fund or paying the penalties associated with taking early withdrawals from a tax advantage account, such as your IRA. The great thing about an S-block is that it lets you fund these investments without liquidating your taxable investment holdings, which allows you to stay in the market with the continued potential of long-term gain. These tend to be no-fee loans with variable loan sizes, and collateralized loans are interest-only lines of credit, so principal payments are not required. Just remember, the loan is secured by the value of the account, so the account value cannot drop below a certain amount relative to the loan size, whether through market losses or withdrawals. We do recommend you pay off your loan as you're able. Now, these loans tend to be variable based on a certain benchmark. Wealth Enhancement through Goldman Sachs uses the secured overnight funding rate plus a few percentage points based on the size of the loan. If you're interested in collateralized loans, I recommend that you reach out to your financial advisor. They can help you determine and set up a collateralized loan if one is right for your particular situation. So, most folks are familiar with high yield savings accounts, whether they are offered by SoFi, Marcus, Synchrony Bank, or some other bank or online account. These are for those folks who wish to earn some interest, but also want to avoid highly volatile investments that have significant downside risk. An FDIC insured high yield savings account can be a go-to strategy for these folks. Generally, these accounts are used to hold a person's emergency fund or other funds with a short-term time horizon, and there's little desire to put these funds at any risk. A high-yield savings account typically has an average percent yield that is higher than a traditional savings account. How much more higher is normally dependent on the interest rate environment. The difference between a high-yield account and a traditional account are generally greater in times of high interest rate environments rather than low ones. These accounts are also FDIC insured at the coverage limit of $250,000 per depositor, per insured bank, per ownership category. So when is a high yield account a good option? Well, you might be looking to earn some interest while you really don't want to be taking on any extra risk at the moment. It's great for emergency savings because it's easy to get at. And any other kind of liquid funds that you have that you don't want to expose to much or any risk. These are generally no fee offerings, although some high yield accounts might have a small fee. The interest earned can range anywhere from 4% to 4.25% based on the account value. But please know that interest rates tend to vary greatly between financial institutions, and you might find some that are lower and higher than what I just mentioned. Okay, let's take a look at money market funds next. Money market funds are mutual funds, and these mutual funds invest in low risk, highly liquid assets like short-term paper, treasuries, CDs, and commercial paper. These are called near cash investments and are considered low risk because one, they're backed by the US government, or two, they're FDIC insured, or three, so short term that the risk of corporate default is minimal. However, they do carry slightly more risk than a high yield savings account, since that account's all cash. So they do tend to earn slightly higher rate of interest when compared to that high yield account we just discussed. And similar to high yield accounts, a money market fund earns a higher rate of return when compared to traditional savings accounts, again, with the spread depending on the interest rate environment. Please note that money market funds, they're not held at a bank, so they are not FDIC insured. Rather, they're covered by the SIPC insurance. And SIPC insurance only covers insolvency of the broker, not market losses. Now, SIPC insurance is very similar to the FDIC. It insures investors up to a limit of $500,000 in cash and securities per account, and up to $250,000 in cash coverage. You're going to say, wait a minute, Daniel, you just said money market funds are FDIC insured, and then you said they're not. So the key thing here is that there might be holdings that are inside the money market fund, and those are FDIC insured. But the money market itself is insured by the SIPC. When might you look at money market funds? Again, these are for investors who have a short-term monetary goal. You might want to reduce your overall portfolio risk, but you don't want to take all the money out of the brokerage account itself, so you'll hold it in the money market fund. You want to earn a little higher interest than what you can get in a high yield account. Or perhaps you're a retiree and your money market fund holds your dividends and interest payments that you aren't having reinvested, so you have the money there available to you easily when you need it. Most mutual funds are either actively managed with a fund manager making independent decisions on what to buy and sell with the fund, or sometimes they're just tracked to track a market index. Money market funds, though, they're a little different. A money market fund's goal is to maintain a stable value of $1 per share, and the gain comes in the form of interest payments, usually made on a quarterly basis. And generally, you don't buy shares. You typically invest a set dollar amount, $5,000, $10,000, $50,000, etc. And unlike a high yield savings account where you get the money immediately, a money market fund must raise cash by selling some of the investment. So there might be a few days lag between requesting the cash and receiving it in your bank. Okay, defensive investments. These are strategies that allows the investor to stay in the market with the potential to earn a return higher than either the high yield savings account or the money market fund that we've just discussed, and still reducing volatility within the portfolio. These types of investments include high quality investment grade corporate bonds, government treasuries, bonds and notes, large cap value stocks, private equity, and private debt. These types of strategies are good for investors who want to stay in the market but don't want to give up the potential to continue to capture upside growth potential of the equity market. So they still want to stay in there ready for when the market starts to rebound and volatility starts to decrease. And then once that volatility does subside, the investor then redeploys back into those riskier assets. High quality bonds, specifically S&P grades AAA and AA, offer the greatest protection of loss when compared to other lower credit quality bonds, while still earning some amount of return via bond interest payments and a potential for some market appreciation. These companies have extremely strong or very strong capacities to meet their financial obligations. Government treasuries earn more interest in a high yield savings account or a money market fund, and the interest earned is based on the maturity of the treasury asset. Typically, longer maturity bonds will pay higher interest than shorter term treasury notes or bills. However, depending on your particular time frame, a short or medium term instrument may be a better fit than a long-term bond. Large cap value stocks. These are very similar to high quality bonds, and they are invested in companies that have the financial strength and flexibility to ride out challenging environments. These large cap value stocks regularly pay dividends, which help to offset the relatively low growth in the stock price when compared to their growth stock brethren. You can think Chevron versus NVIDIA. And private equity and private debt assets, these are investment vehicles that have become more available to the larger general investing public. However, an investor must meet the accredited investor definition. An accredited investor in private equity or private debt must make either $200,000 per year for 2 years, $300,000 if you're married filing joint, or have $1 million in net worth, not including the value of your primary home. Now, these investments carry the most risk of all the strategies we've discussed so far today, and they generally have restrictions on withdrawals. However, these investments have low correlation to broader equity markets. And what this means is that while private credit and private equity both rise and fall with the broader market, they do so but to a smaller extent. So having these assets as part of an overall defensive portfolio can help reduce portfolio volatility while still enabling positive returns. So choppy markets and economic uncertainty can be a challenging time for any investor. And the desire for safety and calm may lead to financial decisions that are detrimental to both your long-term financial health and your stability. And these are times when careful and thoughtful assessment of goals, timing, and appetite for risk should be undertaken by both the investor and your financial advisor. So we've presented a number of strategies that can be deployed separately or in combination to help both reduce overall risk while still earning a return on your money. Now, depending on the current economic cycle and its specifics, some of these strategies may be more relevant than others, but they all have their strong suits and should be considered when there is a desire to put excess cash to work. The underlying thought behind all of these strategies is that they are short to medium term in nature. The cash strategies are short term due to inflation pressures that will erode overall return over the long term. The defensive investment strategies will work in the medium term, but will also lag the overall return of a riskier portfolio over the long term. We strongly recommend that you work closely with your advisor and craft a strategy that is flexible and resilient, but can also meet the moment. Thank you very much for your time. We greatly appreciate it. And now we'll be available for any questions from the audience.
Yeah, so we got a few questions here. Excuse me. The first one, what is the prevailing rate on collateralized loans?
Oh, that's actually a really great question. And you know what? It really depends on the custodian. As I mentioned earlier, Goldman Sachs, they use the 1 month secured overnight funding rate plus a spread to set their interest rate. Schwab and Fidelity also use the same index. But like JP Morgan and Pershing, they actually have their own proprietary index they use. But the important thing to remember is that all the custodians are going to add additional interest on top of the index. That's what we call the spread to get to that final rate. So if you're considering a securities-backed line of credit, talk to the custodian that you're thinking about, find out what index that they use, and then what is the spread they add on top of it. And that spread is usually based on the size of the line of credit you're asking for, not the amount that you borrow. But again, you want to talk with the custodian directly, or again, go through your advisor and they can help you with that.
All right, next one was kind of brought up, but I think it's worth revisiting. Are CDs a good option?
Oh yeah, the good old CD. Yeah, they certainly have a spot in a cash management strategy. Just remember they do have a maturity. So if you cash out early, you're going to pay a penalty, which is usually in the form of some amount of foregone interest. So you just want to be sure that you're matching your needs, your cash need, with the maturity of the CD you're looking at. So obviously, if you have a 12-month need, you don't want to get a 2-year CD, right? But once again, I would recommend that you work with an advisor to create your cash management strategy and just see how CDs might fit in that strategy.
Okay, moving on to the next one. Cash available to me differs greatly related to my age and lifestyle. How should our strategies for cash differ at age 60 versus age 80?
Well, that's another really good question. And I'm going to give you my favorite wealth advisor answer. It depends. So, at 60, you might still be working. So the amount of on-hand cash you might only need 3 or 6 months, maybe 12 of that lifestyle expense that you've got. And maybe if you take a lot of vacations or something like that, maybe you back that out a little bit of that on-hand cash you need. Maybe think of the 3 to 6 months of cash as those necessary expenses, rent, mortgage, food, gas for the car, your utility bills, things like that. If you're 80, again, it kind of depends on your situation. How much of your retirement assets do you have left? What is your amount of Social Security that you're receiving? Do you have another guaranteed income stream, like an annuity? These will all play into how much cash you want to keep on hand. But generally, I would say, excuse me. But generally, I would say for someone, a little older, again, like in those 80s, like you mentioned, you might want to keep about a year's worth of expense available. And the thing here is you might keep some of that amount in like that cash savings account we talked about, like maybe a high yield savings account. And then the balance you can keep in a money market fund. So you're earning a little extra cash. And then when you need it, you simply call up your broker, and then they're able to send that cash to your banking account. But once again, I would recommend that you work with your advisor and see what's right for you.
All right. I think we probably are only going to have time for one more question. So this one, is it a good idea to move some investments from stocks to high yield savings?
Okay. Well, here's the thing. Without knowing your specific situation, I can't really say. But as we talked about, moving money out of the market to avoid volatility and then get back in at the right time, you're not really avoiding risk. You're just trading one kind of risk for another. And that's the thing to bear in mind. And so I would tell you, can you move some assets to savings? Sure. Can you redeploy it into that defensive strategy we discussed? Yep, you sure can. But it's always best to consult with your financial advisor before making big decisions like this, because this is one where it can really have a significant impact on your future wealth. So really best talk with your advisor and put together a strategic plan for that. And it could be, again, we talked about a combination of all the things we talked about. So something could be, maybe you move a certain amount from your high growth NVIDIA, Alphabet stock to the value stuff, right? The Chevron, the Texaco, that type of stuff. And then some goes into a money market fund, and maybe some goes into your high yield savings account. Right? So all of these things can be used together. They're not mutually exclusive. So I hope that answers the question.
All right. Well, thank you very much, Daniel. Again, that's going to be about all the time we have for questions. So if we didn't get to any of your questions, we are still saving all of this, and we'll send it out to your advisor, and they can reach out to you separately. I want to thank everyone for joining us. I want to thank you, Daniel, for being with us today. And again, the session has been recorded. You will get the recording in your inbox, or again, check it out on our YouTube channel. So with that, I will say have a good rest of your day to everyone. Thank you very much, and we'll see you at the next one. Take care.